Hi, everyone. Welcome back to the Ask Avidian Podcast, first podcast of 2025, and Happy New Year to y'all. We've got a special guest today. Andrei Costas is joining us from the investment team. Just to give you guys a little bit of a background, Andrei is one of the portfolio management experts on our investment team. Let's start with just taking a little bit of a look in the rearview mirror. So, this time last year, we were coming off of a really interesting 2023. The market would broadly have said they expect multiple rate cuts. I think somewhere to the tune of 6 or 8 rate cuts in the near future. Again, looking back at January 2024, and a lot of trepidation around the potential growth path for the U.S. and globally, right? As we transition from, more of a tight rate environment, declining rates, how that's going to play out, and what's going to happen with inflation. So, take us back to a year ago. Where do you think we started the year, and how do you think that played out?
Yeah, it's interesting because, rates obviously had a huge impact on not only market activity during the year, but also, overall sentiment. I think quite surprisingly for, most market participants, we continued to get, this dance from the Fed of, really talking rates up and then talking them back, kind of over and over again. Finally, toward the end of the year, in the second half, we did finally start to see some rate cuts. That was welcome news, I think, for many investors.
The first one was everybody was charged about, right?
Oh, yeah, they definitely were. Yeah, especially since it was, 50 basis points as opposed to, kind of a more conservative 25 basis point cut.
Yep.
And so, certainly that set the stage for, what was ultimately a fairly nice rally up until we got into mid-December or so, and we started to see markets kind of pull back some. And again, a lot of that was impacting things like Mag 7, which obviously had been huge drivers of performance really over the last couple of years. And so, I think as we look ahead into 2025, the Fed appears to be again, fighting, kind of their messaging versus what we're seeing in the treasury market, which is obviously, kind of the treasuries actually moving higher. And so, how that all plays out, I think remains to be seen.
Yeah. And if we go back just to spend a little bit more time on 2024, I mean, I think expectations around growth coming into the year, to me, it was a year of surprises, right? So, if you would have polled analysts, you would have polled strategists at the beginning of the year, and again, this was coming off a really tough environment for bonds. Rates were looking to be higher, and coming down. That's typically a tailwind for bonds, especially, kind of longer term treasuries. A declining rate environment would typically mean your bonds are going to have that tailwind, which we, had seen for a very, very long period of time, with the exception of, kind of the early 2020s. And so, expectations around growth early in the year, I mean, I think the narrative of soft landing had replaced hard landing by early last year. Yep. But there was very little thought giving to a no landing environment, which I think is really kind of where the market's gotten to by the end of 2024, call it early 2025. And so, the really strong returns, I mean, and Mag 7 was solid, but really all risk assets were up for 2025.
Absolutely.
And that's not typically the case. And even if you drilled down into like a sector by sector basis, all sectors were up for 2025. Large, mid, small cap were up for 2025. International stocks were up for 2025, not as strong as the U.S. So really everything was kind of lifted last year. And I think a lot of that was due to, call it more tepid expectations coming into the year. And, markets love being surprised by positive news. And so, more positive news, better earnings growth than expectations over time. You mentioned the Mag 7, right? I think the Mag 7's earnings continue to deliver in excess of what people expected. All those things kind of coordinated around a very positively surprising 2024.
That's right. And I think the other thing also to highlight about 2024 was just how surprisingly robust the labor market, was.
Yeah,
and so
everybody that
was
wants
a huge
job
tailwind.
Still, for the most part, has a job. And, so employment's really solid. We keep an eye on the consumer.
Yeah.
The consumer, I think we're starting to see a little bit of a bifurcation. We've talked about this in past podcasts, where, at the lower end of the range, there is some concerns. There's some mounting credit card debt, some mounting credit card and auto loan delinquencies that are giving us an indication that, while those consumers are likely fully employed and have jobs, maybe they're under earning where an inflation adjusted earnings level would have them be, right? So maybe they're still not prospering, although they're employed. And so we're seeing some, kind of pullback on that end of the consumer, but the upper end of the consumer, if we look at equity lines of credit, which is, a decent indicator of whether the upper end of the consumer is doing well or faltering. Those things, equity lines of credit are still robust. We're not seeing any delinquencies there or any mounting delinquencies. Savings rate is still positive. It's not as high as it was, call it in 2020, 2021, where there was a lot of stimulus coming out there, but savings rates are still positive. Early last year, we saw a lot of cash on the sidelines. We advised, invest that cash, don't let it sit on the sidelines. That 5% cash return is going away, and likely that has declined a little bit. It's still there. Still getting decent cash returns. But yeah, definitely a year of positive surprises for really anyone but bond owners, right?
That's right.
If you're a bond investor, as we work with clients, we always remind clients to stay diversified, which means you'll never completely shun an asset class unless it just doesn't make sense for your portfolio. But the bond side of the market, the one tailwind we saw in bonds was credit spreads, right? Credit spreads continued to tighten, which I think that was the surprise, right? And that's that risk on trade. But other parts of the bond market, treasuries, anything longer duration, still a rocky 2024. Is that kind of what you're seeing too?
Yeah, no, absolutely right. I think the bond market, definitely taking a cue from the Fed, kind of throughout the year. But again, with some of that back and forth that we talked about a little bit earlier, I think that's kind of where you started to see, maybe a little bit more volatility there. But again, toward the end of the year, definitely that narrowing of credit spreads, was a kind of a nice tailwind.
Yeah, and so if we look at how we typically advise people to build diversified portfolios, right? There's always going to be strengths. There's always going to be weaknesses in those portfolios. Obviously, strengths, U.S. equities was a strength. Equities overall was a strength. If you had a balanced portfolio, right, you probably saw still high single-digit returns even for a balanced portfolio, which is not a bad year, right? If you're setting your expectations and trying to earn, call it 6% on 60-40, and you got, you looked at 2024, you out-earned that 6% most likely. If we pivot to alts, right? So at Avidian, we use alternatives in a number of different ways. We use public market liquid alternatives. We use private market, less liquid alternatives in portfolios. I think by and large, it was a fairly strong year for alternatives, right? I mean, what did we see in the public market alternatives, for example?
Yeah, no, that's absolutely right. I think when you kind of take a look at the alternative side of the book, we definitely saw a little bit less capital raising activity, I think, overall.
Yep.
And so that being said, sometimes the way that we kind of think about that is, when you're a supplier of capital, when everybody else isn't able to maybe supply capital, that may actually be a tailwind, for future returns. And so, we actually continue to believe that, alternatives is a good place, to look for future returns, better diversification across the portfolio. And so this can be in a number of different areas, whether that's, some select opportunities within private real estate, private equity, private credit, which, has really kind of been, I would say, one of the stars of the alternative universe. People have kind of gone there to get some increased yield and really diversify, their fixed income allocations. Yeah.
So if you had made a decision early in 2024 to say, okay, well, some of my we'll call it fixed income exposure I'm going to put into a less liquid asset class. Mm-hmm. I'm going to put it into private credit. Instead of getting that low single-digit return you got in public market fixed income, investment-grade credit, you probably ended up with more of a high single-digit return on the private credit side of things. And again, this is just 1 year in. We know that right. Private credit, you're going to get a range of returns over your return experience. There's going to be good years. There's going to be less good years. Hopefully, there's no really, really bad years because they do tend to be built with some protection in place in terms of, terms of your loans that you put out there. Hopefully, those are strong terms. But for last year, if you made that decision to go with the private credit route, you likely were happy with that decision.
Mm-hmm.
Real estate, still kind of a different story. I think when you mention, places that are hard to raise assets, right? Raising capital in the real estate space, very difficult still in 2024, which I think, is definitely setting up a strong, maybe not 2025 from a capital raising standpoint, but I think, seeing attractive deals in 2025 and 26, the odds of that those deals materializing as a buyer are, I think the odds are starting to get stacked in your favor. And great entry points for real estate. They just set you up for hopefully above average IRRs, over your experience, right?
That's
so if
right.
you were placing capital into real estate, let's call it, we'll call it the upper level or the top of the market kind of 22, 23 time period, really before those increased interest rates started to bite into that real estate return. Those IRRs and those vintages are going to be a little bit softer. Vintages where you're getting better entry points, we'll hopefully call 2024 and 2025 good vintage years for real estate. Obviously, the jury's going to be out for that for a number of years. But if you get better entry points, you set yourself up for better IRRs. Obviously, there's risk around that. And execution is a big part of that. Picking the right deals is a big part of that.
Yeah, absolutely.
But you are definitely investing where you have a higher likelihood of a tailwind. And if you get any kind of additional easing in the rates market, that's obviously a tailwind, longer term tailwind for real estate. So if we look at, we're turning the page on 2024. We've closed those books out. 2025, I think we're setting up in a little bit of a different backdrop, right? So you've got consensus now focusing much more on growth, and I think what I'm seeing, at least from kind of broad market top-down consensus, is there's a lot of optimism about 2025. I think the transition to a new administration, a refocus on decreasing regulation, a business-friendly environment, all of those things have got the market thinking very optimistically about 2025 and maybe 25, 26. However, we are still, I would call it a restrictive interest rate environment, right? So it's not all positive, although I think the market has kind of turned the page and said, well, now the higher rates are endemic of the growth that we're going to see, as opposed to something that maybe is a little bit more, concerning. But how's 2025 setting up in your view?
It's interesting because with the new administration and some of the talk around, things like tariffs, one of the things that, we're watching very closely is, does that ultimately lead to, kind of a reacceleration of inflationary pressure? And what does that do, to the rate story? That remains to be seen. But again, I think if you look back at kind of prior episodes where we did have tariffs, you can kind of look back to the, administration that came in with Donald Trump. He kind of entered into that trade war with China and some other players, some other trade partners, and that was a little bit inflationary. So again, if you kind of look at that.
I remember that 2016 environment, right? When the narrative around that trade war came to the market, right? And the market started to try to digest that. There was a pretty substantial sell-off. I mean,
that's right.
It was not a fun experience.
That's absolutely right. Yeah. I mean, and so, do we get a replay of that? Potentially, but again, with earnings growth continuing to look fairly good, earnings growth does tend to feed into equity prices. So maybe that helps alleviate some of that.
Yep. Okay.
But again, it's a game of magnitude, I would say. And so how it is that they thread that needle, how the Fed ultimately responds to that. That remains to be seen, and could be a big driver.
So let's think about the market in terms of, kind of what's priced in, right? So multiples on the market today, if you look at the S&P, if you look at growth, if you look at just kind of the broad market overall, they're above average, right? If you're buying equities today, you're not getting a good price. You're getting an elevated price in terms of, if you look at what are you paying for earnings, what are you paying for the book value of companies, really any metric shows that the overall equity markets are expensive. If you focus down into some of the pockets that have been winning, right, like growth stocks or even, the Mag 7, the multiples are even more stretched. And so for us to have a good 2025 in terms of equity returns, the loading is a lot more on earnings growth, as you mentioned, versus on multiple expansion, right? Very unlikely that you're going to turn the page to 2026 and see significantly higher multiples overall, right? So the growth really needs to materialize.
Absolutely.
The one thing that, kind of worries me a little bit is, we try to say there's no guarantees in investing, right? Everything, we're dealing with uncertainty. We're always dealing with predictions as opposed to rules. Mm-hmm. But in my experience, I've been doing this for a little while. I would say there is one, call it immutable law of investing, which is that markets do not like uncertainty. Right, and uncertainty comes in a number of different forms. But when there's uncertainty in the markets, investors tend to pull back. Whether it's they're revisiting estimates or they have a risk tolerance that they can only take so much risk in a portfolio. Increases in uncertainty typically result with investors pulling out of the markets. And while that may not be reflected in growth expectations, right, because firms will still try to grow earnings whether the market believes it's going to happen or not, it will affect firm values, it will affect multiples, and to an extent it can start to affect cost of capital, which can in turn affect earnings growth. So again, looking at where we're at today, I think there's a lot of optimism. Yeah. But when you look at we can call it the Trump's agenda, which includes a lot of change, includes a lot of disruption. I think the end result of that disruption likely is going to be what the market is pricing in today, but there is a path that we have to travel, right? There is going to be disruption in the market, and I think it's fair to say that as we see some of those disruptions, which in a lot of cases will be positive disruptions, they will create uncertainty in the market, whether it's digesting a new regime or digesting a new way that taxes are going to be considered, or inflation and how that affects prices and margins. There's going to be transition. 2025, 2026. And so, that to us creates likely some buying opportunities, right? Yeah. So what do you think about that? I mean, how does that, what do you do? Do you try to time that? Do you try to dollar cost average across that type of environment? How do you handle that?
Yeah, no, I think you're absolutely right. So, we definitely would see uncertainty leading to increased volatility. But again, we as an investment committee tend to look at that volatility opportunistically. And so, we would definitely be, allocating into some of that potential, downside vol. Just in terms of timing the market versus not timing the market, timing the market is extremely difficult to do. It's typically not something that anybody, who knows, markets can kind of say, with a high degree of certainty, we can do this effectively.
I think it's it's fair to say that the longer you invest and the more you dig into markets, the less confidence you have on your ability to time the markets.
Yeah, I think that's absolutely right.
I think with knowledge and experience comes a realization that timing the market is just not a game that you really want to play.
Exactly right. So whether you instead use a dollar cost averaging, as you get capital coming in, or whether you have some type of financial plan that is kind of built around, allocating over time to, a variety of asset classes to get to a target allocation, whether that's public market assets or private assets. I think those are certainly much better ways to do it. And again, it's going to be very much a plan or something that you would need to kind of work with an advisor, on making sure that the objectives that you have, for you and your family are kind of aligned with your approach. And so, again, I think everybody's going to be a little bit different, but overall, volatility is definitely an opportunity. Yeah. And so we would definitely advocate for looking for those opportunities through 2025.
So let's put some names and numbers to those types of opportunities, right? I think, by and large, we spend a lot of time thinking about this here. In our view, a lot of our clients are getting kind of tired of the 60-40, right? That is not the end of asset allocation for us. That's just kind of the starting point, the tip of the iceberg. I think if you took the 60-40 approach over the last couple of years, you're probably a little bit unhappy with the results. If you just take a little bit of a broader perspective and you include some liquid alternatives, likely 2024 was a better experience, right? So as you gain diversification, even if you're not gaining in terms of total return, gaining diversification is good for portfolios.
Absolutely.
A more well-diversified portfolio will compound returns better over time than a portfolio that has more volatility.
That's right.
And so as we set up for 2025 and beyond, and we think beyond this, 60-40 concept. I mean, I've seen the term 50-30-20 thrown out there. I've seen the term, liquid alts. I've seen private alts. I've seen mixtures of the two. How are we guiding, we'll call it our advisors, how are we guiding our clients in terms of asset allocation, for not just this year, but for this year and beyond?
Yeah. So as far as asset allocation goes, what you say is absolutely right. 60-40 is, the traditional approach. But we here at Avidian see that really very much as a core kind of foundational piece. But there are definitely other things that, investors should be considering incorporating, again, to get those benefits of, potentially better future returns, lower volatility, potentially, some increased yield generation potential in the portfolio. And so, the way we would kind of guide there is you kind of start with your traditional asset allocation. Again, this is going to be your equities, your fixed income, and again, all constructed based on your objectives, your risk tolerance. But then we would also begin to bake in whether that's 10% or 15% or even more than that to alternatives, whether that's liquid or fully private alternatives.
Yep.
And again, on the alternative side, what we would definitely say is that vintage year diversification, which we touched on earlier, is really important. So, maybe you're not allocating to those private market opportunities all at once, but you're kind of scaling into those maybe over a multi-year period to make sure that you do have that diversification from a vintage perspective.
Yeah, that's a really good point. So you have to move from no alts to some alts, right?
Right.
It has to get something in your portfolio has to come out to make room for that. And I think that decision of what do you pull out, what do you take out of the portfolio to make room for these alternatives, right? That's going to be different for every client. It's going to depend on how much liquidity risk you're going to take, right? Which portion of your assets do you need to have access to tomorrow if you need them? Hopefully for a lot of people, that's a small portion, because the less liquidity you need tomorrow or within the very near term, the more flexibility you have when it comes to investing and accessing things that don't provide that liquidity. So that's one part of the equation. The objective of the portfolio matters too. So are you trying to drive a higher income portfolio? Maybe that means you use those private credit assets that we talked about that did really well in 24. I think they're still set up to do fairly well in 2025. We haven't seen yields collapse like I think a lot of people thought you would see. Spreads are still fairly healthy. We are looking in different pockets of the market. We're not going to just set our sails and blindly sail off into the sunset with the things that worked in 2024. So we're making sure that we understand what pockets of the market make sense for private lending. But that's not a bad idea or a starting point for somebody that's looking to generate income.
Right.
On the private equity side of things, private equity, growth equity, venture capital, those are terms that we throw out a lot.
Yeah.
But really what that means is, instead of investing in companies that you can see on the stock exchange, call it Exxon, call it Apple, call it the Mag 7, you're investing in businesses that are not publicly traded. They're still U.S. businesses in a lot of cases. Sometimes they're multinational businesses. Sometimes they're really solid financially. They have strong earnings growth potential. They're just not traded on an exchange. But in exchange for that, you typically get better entry points from a pricing perspective. One of the things I think is kind of interesting, and we'll call this maybe a 2025, 26 tailwind, is, and this I think kind of stems from some of the thesis that we have to use private markets in the first place. One of the reasons that we use private markets is because we've watched the public market sector get smaller over time.
Oh yeah.
Not in terms of market cap, right? Market cap, it's huge. Valuations are very high. But in terms of the number of companies that you can choose to invest in, that number has continued to get smaller over time. It's roughly half what it was, 15 or 20 years ago.
That's right.
And those companies still exist. They're just staying private. And so while I think that dynamic has created a strong opportunity to invest in private markets, at some point, it's likely that it's going to revert somewhat. And what that means as a private market investor is that there are more potential forward-looking public exits for those private companies. And if we go back to the thesis of why we like private markets in the first place, private markets, you tend to get more cash flows for the dollars that you invest, right? We call that cheaper valuations. So instead of buying a company at 20 times EBITDA, maybe you get that company at 8 times or 6 times, or in some of the individual company transactions that we've participated in, 1 times EBITDA, right?
That's right.
That's a great entry point. So if your entry point is low, but then you have a potential exit into the public markets where, again, you come back to that 7, 8, 9, 10, 15, 20 EBITDA multiple, those are really good exits for investors that are already in the private market companies, right?
Absolutely.
So that's a tailwind, right?
Yeah, absolutely. And I think the other thing, to also keep in mind is that a lot of these private businesses or private companies that you can invest in private markets, these are not small businesses. I mean, if you kind of look at the overall, landscape, you're looking at north of 86 or 87% of these generating north of $100 million a year. So again, there's definitely ample opportunity to allocate to these, in many cases, mature but not necessarily public opportunities.
Well, I think another thing to bring up too is that private also creates this this idea that it's opaque, right? And most of the private companies, and I would venture to say all, but I don't want to go quite that far, they have audited financials, right? Ernst & Young has looked at their income statement, their balance sheet, and said, yeah, this is legitimate. We're verifying these results just like we would verify any public company. So I want to make sure that we don't conflate private with opaque or with a lack of transparency. There's more work to be done to understand and peel back and understand what you're investing in, but it's not an opaque, non-transparent investment.
That's right. That's right. And that's really the importance of the due diligence process. You want to make sure you have a repeatable and robust due diligence process so that, you can look into those things and verify and confirm that what a company is telling you is in fact, kind of the truth. So
yeah. Okay, so for our listeners today, right, I always like to leave them with a little bit of a to-do list.
Yeah.
And hopefully some of the listeners are our clients, and some of them maybe they'll be our clients in the near future. What are some near-term, okay, I got to talk to my advisor next month. What questions should I bring up if that advisor doesn't bring them up to me?
Yeah, so it's a great question, but an important one, especially as we, kick off a new year. So I would definitely say, number one is a review of an over-allocation relative to, your objectives. So you want to make sure that those things are aligned. You don't want to end up with a portfolio that, has maybe one mandate, but is misaligned with, what you're ultimately trying to achieve over time. So that's number one. You want to make sure that that's aligned. I would say another thing, that you definitely want to talk to your advisor about is there a process? Do you have a way to assess the market to address, some of the risks that, may ultimately come up in 2025 and 26? And what does that look like? Is it repeatable, or is it, somebody that is kind of promising, that they can time the market, by reading, tea leaves that you don't know, you don't want to make that mistake. And so as you are talking to, advisors, you want to make sure that that's, in place.
Yeah. Okay. Those are, great points, Andrei. I think the other thing that, kind of comes to mind as I think about this is concentration.
Yeah.
No pun intended. And, concentration, I think, and I'll call it concentration risk, really all that is you have, fewer and fewer things determining the outcome of your financial well-being. And, call it 10 years ago, we used to see a lot of concentration risk when clients would come in the door and they would have concentrated individual stock positions because they worked at that company, right? Yeah. I think in a lot of cases, you still see some of that here and there, but I think a lot of, executives have learned to diversify as they build their careers. Yeah. Now what we're seeing is just, kind of clients coming in with concentrated portfolios as a result of the success of some of the stocks that we've seen in the market, the Mag 7.
Yeah.
And so especially if you've been, if you're a U.S. investor, and typically U.S. investors have a U.S. home country bias, which means they own more of, call it the S&P 500 than, anybody else around the world. And then within that S&P 500, you own, I think the top 10 stocks account for about 40% of the overall market cap. So really within that, big piece of your portfolio, you got a fewer and fewer number of things that are determining your outcome. You just want to, take a look at that and see how those concentrations may have built up over time, whether it's the last year, whether it's the last 5 years. And, we would never say, okay, well, you just want to exclude and remove all that from your portfolio. You just want to make sure that it's not the only driver of your personal financial success. And so just looking at the concentration in your portfolio, doing a revisit with your advisors. Yep. If they can't do that, revisit for you, give us a call at avidianwealth.com.
Yeah. And I'll say the other thing, especially with ETF portfolios becoming more and more popular, it's important to do that drill down underneath the hood, because again, a lot of these ETFs also own the same securities, and so while
the overlap, right?
That's right. So you want to make sure that's in a place that is appropriate for your portfolio.
Yeah. Andrei, this has been a lot of fun. I appreciate you joining me. If you do have any questions, or if you want to connect with us and get more detail, definitely come check us out at avidianwealth.com.